Imagine you wake up tomorrow and every single debt in the world is wiped clean. Every mortgage, every student loan, every credit card balance, every government bond, gone, zero, overnight. Sounds like a dream, right? But here's the thing. The moment that happens, something else disappears too. Your pension, your savings account, your retirement fund, the money your grandmother put away for decades. All of it, gone. Because here's the dirty little secret that nobody talks about. One person's debt is another person's asset. And if you don't understand that sentence, you don't understand money. Not really. So today, we're going to fix that. We're going to pull back the curtain on one of the most misunderstood concepts in all of modern finance. We're going to answer the question that sounds simple but breaks most people's brains when they actually think about it. If everyone is in debt, who exactly is the creditor? Stick with me, because by the end of this video, you're going to see the entire financial system differently. And once you see it, you cannot unsee it. The illusion of everyone is in debt. Let's start with the phrase itself. Everyone is in debt. You've heard it. You've probably said it. It gets thrown around on social media, in political speeches, in dinner table conversations. And on the surface, it feels true. Consumers are in debt. Corporations are in debt. Governments are in debt. The United States alone carries over $34 trillion in national debt. The UK, Japan, France, all of them drowning in obligations that seem impossible to repay. So, yeah, everyone is in debt. But wait, stop right there. If everyone owes money, to whom are they paying it? Debt doesn't exist in a vacuum. Debt is a relationship. It's a contract between two parties, the one who owes and the one who is owed. You cannot have a borrower without a lender. You cannot have a liability without an asset on the other side of the ledger. This is called double entry accounting, and it's the foundation of every financial system on Earth. Every single dollar of debt that exists is simultaneously someone else's asset. It's not a coincidence, it's not a loophole. It's literally how money works. So when people say everyone is in debt, what they're actually revealing, without realizing it, is that they only see half of the balance sheet. Let's look at the other half. Sabi doon, the creditors. You already know. Here's where it gets interesting, and maybe a little uncomfortable. The creditors, the people on the other side of all that debt, are not some shadowy elite hiding in a bunker somewhere. Well, sometimes they are, but mostly, the creditors are us. Let me explain. When you put money in a savings account, what do you think the bank does with it? It lends it out. Your deposit becomes someone else's loan. You are technically a creditor to the bank. The bank owes you that money. That's what a deposit is. It's a loan you made to the bank. When you contribute to a pension fund or a 401k, that fund takes your money and invests it. A huge portion of those investments are bonds, which are just loans to governments and corporations. Your retirement savings are, right now, the creditor to some government's debt. When you buy a government bond, directly or through a fund, you are lending money to that government. You are the creditor. The government is in debt to you. This is the paradox hiding in plain sight. The average middle-class person who complains about government debt might simultaneously hold, through their pension, a slice of that very same debt as an asset. So, everyone is in debt is actually only half the story. The full story is, everyone is in debt to everyone else. And that network of obligations, that web of who owes what to whom, is what we call the financial system. The three main categories of creditors. Now let's get more specific, because not all creditors are created equal. When we zoom out and look at the global debt picture, there are essentially three main categories of creditors, and understanding them changes everything. The first category is institutional investors. These are pension funds, insurance companies, mutual funds, sovereign wealth funds. These entities hold trillions of dollars of debt instruments. They are the silent giants of the creditor world. When Japan issues a government bond, it's often Japanese insurance companies and pension funds that buy them. When the U.S. Treasury issues debt, the Federal Reserve, Foreign governments and institutional funds are on the other side. These institutions don't hold this debt for fun. They hold it because their clients, regular people, retirees, workers, need safe, stable returns. So in a very real sense, the creditor behind much of the world's government debt is the working population saving for retirement. The second category is commercial banks. Banks are creditors in a very direct way. When a bank gives you a mortgage, it becomes your creditor. When a bank buys government securities, which they do constantly because regulators require them to hold safe assets, it becomes the government's creditor. But banks are also borrowers. They borrow from depositors. They borrow from central banks. They borrow from each other. Banks sit in the middle of the debt web, simultaneously acting as creditor and debtor, creating a chain of obligations that spans the entire global economy. The third category is foreign governments and central banks. This is the one that surprises people the most. China holds about $800 billion of US government debt. Japan holds over $1 trillion. These countries accumulate US treasuries as foreign exchange reserves. They're essentially using American debt as a savings account for their national wealth. So when Americans talk about the national debt as a crisis, part of what they're saying, without realizing it, is that China and Japan have been very willing to lend to them for decades. Funny how that reframe changes the emotional weight of the conversation. Where does money actually come from? This is the part of the video where things get a little mind-bending. So take a breath. Most people think money is created by governments printing it. And yes, that's part of the picture. But it's not the whole picture, not even close. The majority of money in a modern economy is created by commercial banks through the act of lending. Here's how it works. When a bank gives you a mortgage for $300,000, it doesn't go find $300,000 sitting in a vault and hand it to you. It simply types $300,000 into your account. It creates that money digitally on the spot. Your loan is a new liability for the bank. But simultaneously, that mortgage, your obligation to repay, is a new asset for the bank. New money was just created, out of thin air, backed by your promise to repay. This is called fractional reserve banking, and the Bank of England literally published a paper in 2014 explaining exactly how it works, because so many economists had gotten it wrong for so long. The implication of this is staggering. It means that debt is not just a record of money changing hands. Debt is the mechanism through which money itself comes into existence. When debt is created, money is created. When debt is repaid and destroyed, money is destroyed. So in the deepest sense, the answer to who is the creditor is partially the banking system itself, because it's the banking system that conjured the money into existence in the first place. The government debt illusion. Let's talk about national debt specifically, because this is where the most confusion lives. Politicians love to talk about national debt like it's a household credit card. We're leaving this burden to our children, they say. We need to tighten our belts and pay it back. It's a compelling narrative. It's also deeply misleading. A country that issues debt in its own currency is in a fundamentally different position than a household. When the US government issues a treasury bond, it is borrowing in US dollars, a currency that only the US government can create. The creditors of US debt are people who voluntarily exchange their dollars for a dollar-denominated IOU that pays interest. This isn't to say national debt is irrelevant or risk-free. It's not. Inflation, currency devaluation, rising interest costs, these are real concerns. But the idea that America is going to go bankrupt the same way a household goes bankrupt fundamentally misunderstands what sovereign debt is. More importantly for our question today, domestic government debt is primarily owed to domestic creditors. The US owes most of its debt not to China, not to foreign powers, but to its own citizens, its own institutions, its own Federal Reserve. It owes it to the Social Security Trust Fund. It owes it to pension funds holding treasury bonds. It owes it in a roundabout way to the people who will retire in 30 years and expect to receive those Social Security payments. So when a politician says, we owe $34 trillion, The follow-up question is, to whom? And the honest answer is mostly to ourselves, which doesn't mean it's not a problem, but it is a very different kind of problem than the headline implies. The rich get richer. And here's the mechanism. Now, we need to talk about the uncomfortable part. Because while it's true that regular people are creditors through their pension funds and savings accounts, it is not true that all creditors benefit equally. There is a structural asymmetry in the debt system that systematically transfers wealth upward. And once you see it, you can't unsee it. Here's how it works. When central banks lower interest rates, as they did aggressively after 2008 and again in 2020, borrowing becomes cheap. People with access to capital can borrow enormous sums at near zero interest rates and invest that money in assets, real estate, stocks, private equity. The assets go up in value. The wealthy get wealthier. Meanwhile, savers, people who don't have investment capital, who keep their money in savings accounts, get crushed. Their savings earn almost nothing, and inflation quietly erodes the purchasing power of whatever they do hold. So the debt system in practice has acted as a massive redistribution mechanism. Not from the rich to the poor, but from savers to asset owners, from those who lend conservatively to those who borrow aggressively to buy appreciating assets. This is why wealth inequality has exploded over the past 2 decades. It's not just greed. It's the mechanics of a low-interest, high-debt environment interacting with asset ownership concentration. The creditors that benefit most from the system are not your pension fund. They are the entities sophisticated enough to borrow cheap money and deploy it into high-returning assets faster than inflation can catch up. That's the game, and most people don't even know they're playing it. What happens if the debt is never repaid? This is the question that keeps economists up at night, and the answer is more nuanced than either camp, the debt is fine camp, or the we're all doomed camp, usually admits. The truth is, most debt is never fully repaid. It's rolled over. Governments refinance their debt constantly. They issue new bonds to pay off old bonds. As long as the economy grows faster than the debt accumulates, the ratio stays manageable. But what happens when it doesn't? What happens when the music stops? History gives us a few answers, and none of them are fun, but they're instructive. Option 1, inflation. You inflate your way out of debt. Print money, reduce the real value of what you owe. This is what Weimar Germany did, what Zimbabwe did, what many countries have done in various degrees. The creditors, the people who lent you money, see the value of their assets destroyed. The debt nominally gets repaid in worthless currency. Option 2, default. You simply say you're not paying. Greece did a version of this. Argentina has done it multiple times. Creditors take losses. The country loses access to international credit markets. It's painful, but life goes on. Option 3, growth. You grow your economy fast enough that the debt becomes manageable relative to GDP. This is what the US did after World War II. Massive debt, massive growth, and by the time a generation had passed, the ratio had come down dramatically. Option 4, austerity. You cut spending and raise taxes to pay down the debt. This is politically brutal. It slows growth. The social costs are enormous. Most economists now view it as largely counterproductive. There is no clean answer. There is no exit door that doesn't require sacrifice from someone. The question is always whose sacrifice? That's a political question, and it's the reason debt is never just an economic issue. So, who is the creditor? Let's bring it all home. You asked the question. If everyone is in debt, who is the creditor? The answer, now that you have the full picture, is this. The creditors are everyone, and the system is designed so that those with the most capital benefit from it the most. Specifically, the creditors are pension funds, which means, indirectly, workers saving for retirement. The creditors are banks, which created the money through lending in the first place. The creditors are foreign governments, holding each other's debt as geopolitical leverage and financial insurance. The creditors are wealthy individuals and institutions, who use debt as a tool to acquire assets, while regular people use debt to survive. And the creditor is the system itself, a self-reinforcing architecture of obligations that requires perpetual growth to function and transfers wealth silently from those who don't understand it to those who do. This is the most important financial literacy lesson you can learn. Debt is not just something that happens to you. Debt is the operating system of the modern economy. Understanding which side of it you're on and how to use it strategically rather than be used by it is the difference between building wealth and spending your life servicing someone else's asset. What you can do with this knowledge. Knowing all of this is powerful, but only if you act on it. Here's what Max has been thinking about when it comes to practical takeaways from understanding the debt system. First, stop thinking of debt as inherently bad. Debt used to acquire appreciating assets, or real estate, equity in businesses, education that genuinely increases your earning power, is the same tool the wealthy use to get wealthier. Debt used to consume, credit cards, car loans for depreciating vehicles, buy now, pay later for lifestyle spending, is the trap. Second, understand what your savings actually are. If your money is in a savings account at 2% interest while inflation runs at 4%, you are a creditor losing money in real terms. You are lending to the bank and they are paying you less than your purchasing power is eroding. That's not saving, that's a slow leak. Third, look at the creditor side of the ledger. Where is your pension invested? What assets does your savings fund hold? Who is your money lending to and at what return? Most people have no idea. Knowing this is the first step to managing it intentionally. Fourth, think about leverage carefully. The wealthy use low-cost debt to acquire high-returning assets. You can do the same at a smaller scale with discipline. But it requires understanding risk. Leverage amplifies both gains and losses. The people who got wiped out in 2008 didn't fail because they used debt. They failed because they used debt without understanding the downside. Here's the bottom line. Everyone is in debt is only a terrifying statement if you forget that debt and credit are two sides of the same coin. The financial system is not a giant sinkhole where money disappears. It is a network of obligations, a web of promises, a machine that creates money through the act of lending and destroys it through the act of repayment. The question isn't whether you're part of this system. You already are. Everyone is. The question is whether you're going to be conscious about it, whether you're going to understand the rules of the game, whether you're going to position yourself on the creditor side, even occasionally, even partially, or spend your entire life on the debtor side, generating returns for someone else's balance sheet. Money is a story we all agree to tell together. Debt is a chapter in that story where two people look at the same number, and one calls it a burden and the other calls it an asset. Make sure you know which character you're playing. If you found this valuable, smash that like button and subscribe. We cover this kind of deep dive financial content every single week. Drop in the comments. Did this change how you think about debt? I read every single one. See you in the next one.